G'day and welcome to this week's video. My name is Robert Gowdy from Consortium Private Wealth, and this week I thought we'd have a quick look at the new buyback that's on offer, and this is from Westpac. We've just seen Woolworths and also Commonwealth Bank come out with their own share buyback, and I thought it'd be timely to go through nice and early so people can get a good understanding of what the buyback entails and what it looks like from a value point of view for our clients. So let's just roll through the presentation, and at the end we'll go through some calculations because this one's it's a little bit different, although structurally it's exactly the same, but it's not as attractive from a franking credit point of view. So we'll run through that. So the facts are they're going to buy back up to $3.5 billion worth of stock, and each share is going to have a capital component of $11.34, and this is where it's very different to the previous buybacks. The Commonwealth Bank had a capital component of $21.33, I think, somewhere there, don't quote me on that, but the share price at the time was over $100, so that's where it's substantially different. Any amount above the capital component will be treated as a fully franked dividend, and tenders, people need to sell their shares at a discount between 8% and 14%, the market price. And at the end of this video, I'll go through our calculator that we use to highlight obviously what the value looks like for investors. So let's run through what the numbers do look like without going to the calculator, and this is assuming that we would use the maximum 14% discount, and that's what we normally do for clients that are in a nil tax environment. It's very attractive to participate in these, so we would always utilize the maximum discount, which is 14%. So we've done that as though we're treated as any other buyback, and that will give us a sale price where Westpac gets to buy each share back at $20.08. Capital component of $11.34 leaves a fully franked dividend of $8.74, which will give us a franking credit of $3.75. Now that really just gives us a premium of less than 50 cents per share, or I think it's around $2, just over 2%. So really not that attractive, and that's only for people in a nil tax environment. So at the discount of 14% is actually not that attractive, and you have to be in a nil tax environment to get that small uptick of just over 2%. Now if we go and have a look at the calculator now, we can see here that we've got all the figures for the Westpac Bank, the figures we had in the presentation. So the current price $23.35, the 14% discount, which means we're selling back at $20.08. There's the capital component, fully franked dividend, and our franking credit calculation there. We can see here we've got a marginal tax rate. Tax rate is absolutely important. You can see here even a superannuation fund in accumulation mode, it's not worth doing. You're losing money. So we'll go back to superannuation in pension mode, which gives us the 48 cents premium, which is just over 2%. So really not worth doing. But imagine if we've got a little bit more scope here, we can choose to discount our shares at 8% and not the 14% to say, well, we're not going to give you as much value, Westpac, so we'll only sell you shares at 8% discount, which is $21.48, which means the franking credit is larger, the capital component stays the same, so we now have a franking credit of $4.35. In a nil tax environment, all of a sudden we're getting $2.48, premium above the current share price, which is 10.62%, which all of a sudden that makes it worthwhile. At 10% tender discount, $1.88, and obviously that's still worthwhile picking up 8% or thereabouts. So this one's a little bit different to what we've done in the past. We've generally always gone in at the 14% thinking, well, there's so much value, the franking credits are so big that it's well worth doing. But in this scenario, even in a nil tax environment, that is nothing short of ho-hum. To make any value there, we're going to have to issue obviously a tender discount of well less than the 14, and to get a 10% bump to the current share price, you'd need a tender discount of 8%. Now, this is not financial or tax advice. As a comment, I'm not making any comment on Westpac as a future investment. You need to talk to your financial advisor, and obviously this is a lot of tax happening within here, so please speak to your registered tax agent, your accountant, before moving ahead with any advice in relation to this share buyback. They are a little bit complex, but I hope that's made it a little bit easier for you. Thanks for listening, and we'll catch you next week. Bye.